Now on to our speakers tonight. I do want to make mention that we originally had planned to have Tony Crescenzi from PIMCO as our fixed income panelist. Unfortunately, he had a personal issue and was not able to fly in from California. We do want to invite Tony to come speak to our society at a future date. And we're very fortunate that Matt Toms is going to fill in for Tony as our fixed income expert. In addition, we were also very fortunate to get Paul Zemsky at the last minute to fill in as moderator for our dinner tonight. Paul Zemsky is a CFA charter holder and Chief Investment Officer, Multi-Asset Strategies and Solution at Voya Investment Management. He is responsible for the firm's suite of value-added customized products and solutions that are supported by asset allocation, manager research, quantitative research, portfolio implementation, and multi-manager capabilities. Please welcome Paul, and he will now introduce our three panelists.
Okay. Well, thank you, George, for that kind introduction, and sorry I'm second prize, but glad to be here. So what a great time to have a panel like this assembled. We're on the eve of what we hope is a very significant move by the ECB tomorrow. We have potential Fed tightening in the US later on this year, disappointing growth in China, signs of life in Germany, not sure what's happening in Japan, and some recent very positive news out of India. So a lot going on in the world, and I couldn't think of a better group of panelists to discuss it. We're going to go in order. On introductions, to my immediate left is Jonathan Golub. I've had the pleasure of knowing Jonathan for over 6 years, and he has a very distinguished background as being chief strategist at JP Asset Management, a number of sell-side firms, and most recently now at RBC Capital Markets. Next to Jonathan is Steve Sears, is a senior editor and columnist with Barron's, writing both a weekly and daily piece, The Striking Price, both weekly and daily columns. And he's also the author of a book that many of you have at your seat, The Indomitable Investor, Why a Few Succeed in the Stock Market When Everyone Else Fails. And then finally, we have Matt Toms, who is head of public fixed income at Voya Investment Management. And Matt has led a team that over the past 5 years has delivered top decile returns in a very volatile and treacherous fixed income market. So very interested in hearing what Matt has to say on both domestic and global fixed income. So the format tonight is that each speaker will be speaking for 5 to 10 minutes on their views. Then we'll open it up to questions. I certainly have some I could prod them with, but we really hope the audience, I'm sure no one's shy here, so I have plenty of questions from the audience. So with that, I'm going to turn it over to Jonathan, and he'll start, and we'll go down the dais here, and then we'll open it up to questions.
All right, Paul, before I start with my forecast, I have to tell you a very funny story.
Okay.
So last week I did a forum like this, except it wasn't professional investors. It was a group of high net worth individuals, and I would say it was an older group of high net worth individuals. And so gave a relatively similar kind of outlook on what the markets were. And the first question, an older man comes up and he says, "Young man, I just want you to know how excited I was with your speech and how optimistic you are. But I know what you think about equities. Tell me where stocks are going." So hopefully the questions will be a little bit more directed. Of course, what the answer was, I really appreciate your question. It's really all about diversification that matters, and he felt reasonably.
Very
hopefully
nice,
this will be a little bit more directed. Anyway, I'm going to in my outlook. And I'm sorry that I found it more humorous than anybody else did. But anyway, on the outlook, I'm not going to talk about oil. I'm not going to talk about the dollar. I'm not going to talk about Fed policy because I think these guys will cover some of that, and we could probably cover it in Q&A. My outlook for the year is last year we had a 2075 market target. If the year would have ended one day earlier, we would have hit the target, and we were a little bit shy of that. I think the year ahead we have a 2325 S&P, which would have made me on the board, not the high, but among the highest numbers up there. And that's equivalent to about a 13, maybe a little shy of a 13% return for the year. The more important thing in terms of my outlook, I believe that we are in a slower than normal recovery. I think that's pretty obvious, but I think as a result, the economic cycle is going to drag on longer than it normally would. I don't believe that we're in year 6 of a 7-year cycle. I think we're in year 6 of maybe an 11 or 12, I don't know, but something substantially longer. And when you have non-recessionary years, the market tends to deliver double-digit returns, and you give a lot of that back during your next recession, and that's likely to be further in the future. So what I think you're looking at is a 12 to 15% total return environment, including dividends, for the equity markets, not for next year, but for the next 3 or 4 years. If you compound that out, you're talking about a 50 to 75% upside between now and the end of the cycle, and I think that that's a pretty bullish call. However, the way that I get there is not with the assumption that many bulls have, which is that we're going to have a big capex cycle and the economy is going to pick up. It's exactly the opposite. I think that we're stuck in a 2.5% GDP environment. I don't think that's a disaster, but I think it's actually quite different than what we've seen. And then the question is, if we are in that slower environment for a variety of reasons on global growth and China growth and demographics and the like, how does that translate into a market, a set of market behaviors? What does that mean for interest rates, discount rates, stock valuations? How do companies respond in a slower environment? Do margins go higher because companies need to squeeze more out, or do margins, are they at a peak and are they about to roll over? So that's really the question. If I look at last year's return, which was just shy of 14 if you include dividends, and I'm going to use a little bit of squishy math to make the numbers work out. Of the 14% total return, 2% of it was dividends. That gives you about 12. Of that 12, about 6% of the 12 came from PE expansion. That gave you 6. Of your 6 that you got from EPS, 2 came from buybacks, 2 came from margins, 2 came from revenues, and what you had was a relatively weak economy of about 2.3% in 2014, leading to a pretty solid year for markets. And I think that that's exactly what we're going to be looking at for the next several years. When I talk to investors, what they're a bit challenged by is how do you reconcile weak economic growth with a market that's up 200+%? And for a variety of reasons, I think that that's going to continue the market will continue to roll forward and we'll continue to scratch our heads. And that is the wall of worry. This year, this past year, 2014, assuming that the GDP number comes in even in the ballpark of expectations, which is about 2.5 for the fourth quarter, this will be the 9th calendar year in a row of sub 3% GDP. And every single year, GDP was forecast to be well in excess of 3%. And so you've had a colossal miss where economists and forecasters were way too optimistic on the economy. And I think if you've had this long a string, maybe in fact we're just in a slower growing world and we need to address that. It's very clear that corporate executives, if you look at corporate guidance, they're basically consistent with 2% GDP growth, 4.5% revenue growth. That means that companies are setting spending policy on CapEx and SG&A in line with a weaker growth trend. If the economy surprises us and gets better, profits rip. But if they don't, what companies are doing is if they expect revenues at 4.5, they set their spending policy at 4 on expenses, and if expenses go up at 4 and revenue goes up by 4.5, you get margin expansion. That you're talking about an incremental baby amount of higher margin. So you go from a margin on the S&P of 10 to 10.1. But if you add that, if you have 4.5 revenues, you add 1 extra % on margins, you're at 5.5. You do 2% of buybacks, you're at 7.5. And that number for EPS growth is pretty close to long-term averages, and so that you have this disconnect. With respect to valuations, I think the issue is really quite simple. Take any company in the S&P 500, look at the yield on the corporate bonds, look at the earnings yield on the stock, and you basically have a huge disconnect between the cost of capital for the company and what the stocks are trading at. And over the next several years, that relationship should close. Put differently, stocks are just a screaming buy compared to bonds, and therefore capital should move towards the stock market, pushing those valuations up. And that is, to a certain extent, made easier by lower interest rates. Why? Everybody's concerned that when interest rates rise, that's going to kill equities, or it may kill bonds, but kill equities. In general, when interest rates are low and they rise, that's seen as a renormalization of business conditions, and stock valuations go up. Just one last thought. Where do you want to invest within the equity markets? If there's not a lot of growth, companies that can deliver growth in the absence of an economic pickup, so secular growers, those should be your most natural place to invest. That would include biotech, it would include technology, it would include healthcare in general, and certain areas within discretionary such as media. So I'll stop there, and we can take more on this in the Q&A.
Okay, thanks, Jonathan. Steve, over to you.
Thank you, Paul, and thank you for the invitation to be here tonight. What I want to try to do is give you a contextual view of how the options market views the Standard & Poor's 500. And the way I want to do that is by giving you a volatility forecast for the SPX and also for the VIX. In all my years, I can't recall a year beginning with as much confusion and as much anxiety. And I think many people would naturally translate that into a high volatility regime for equities. But in fact, the opposite is true, and we're sort of seeing the year as being set up in a bifurcated way. Now, for 2014, it's important to understand that realized volatility for the Standard & Poor's 500 was 11.4. This largely reflected the market's grind higher and improving economic data. It's thus reasonable to expect that 2015 will be another year of low volatility for the Standard & Poor's 500 index. Now, the expectations across the street forecast XBX realized vol, and realized volatility, of course, is the magnet that really controls implied volatility, of 13 to 18. So if realized vol is 13 to 18, what that suggests is that the SPX moves 0.81% to 1.1% each day. Is that too high or too low? That's what the models tell us right now, and these models are largely based on economic data. They rely heavily on the ISM, consumer spending, and unemployment. Now, to give you a longer view of SPX vol, consider that since 1960, SPX realized vol was 11.7 when ISM's new orders, the guts of ISM, exceeded 60. In December, as you all recall, the new orders index were at 57.3. Now you move ISM new orders between 55 and 60, SPX realized vol is at 12.2. Now with the real GDP growth between 2.5% and 4%, you see SPX realized vol has averaged 12.7 since 1960, pretty low. Now VIX, of course, is a different beast, and many people confuse SPX and VIX. VIX has a much different construction. It's based on the SPX, but it is not the SPX. In all candor, if you look at the trading patterns, I think you can pretty much play pin the tail on the donkey with the VIX. We know it's volatile and we know it's whippy, but to sort of give you a framework or a benchmark to look at it, Goldman Sachs has come out recently and said that if VIX is above 16, they want to sell it, and if VIX is below 16, they want to buy it. It closed slightly below 19 today. And so as the options market looks at equities, you're going to see really there are two views. You can think of the SPX as the more strategic view. I have a portfolio, I want to reduce the risk, I want to add exposure in a cost-effective way. And you can think of VIX as your sort of aggressive, tactical trade. So even though SPX will probably come in between that 13 to 18 range, you can just pick what your number is based on your model. VIX will be incredibly whippy. We saw this in October, we saw it in December, we've seen a little bit of this in January. I've taken to calling these sort of VIX whips, like volnadoes. They seem to come out of nowhere, and if you watch the trading patterns in the options market, you'll see people start to buy upside calls or in anticipation of events, and it sort of becomes almost like a flash mob mentality. Now, everybody is aware of tomorrow's ECB decision, Everybody's aware of the Fed raising rates, and so what you sort of see is you look out on the VIX, even though the VIX futures curve is as flat as a pancake, you'll start to see these sort of options and futures trades go on around these events. I think people are just betting on the outcomes. And you're going to see this not only around the big major events that we know about, ECB and Fed, but anytime that there's a piece of the puzzle that helps to complete the data set, you're going to see this sort of vol-NATO trading coming up, because it's a fairly cheap bet for a lot of guys who are trailing their benchmark. Now, if VIX is around 19, and many of you know that's its long-term average, I think you could very easily see it trade to 30. Why would it trade to 30? Yes, because the stock market, if it trades off, the VIX is designed to essentially move in the opposite direction, but this is sort of big animal spirits trading as well. Now, there are a couple of other factors that will contribute to volatilities this year. You're going to see this a little bit in the SPX. You're going to see this quite a lot in the VIX. And it's that many of the big iBanks who help to make the markets and commit capital are no longer committing capital to fairly vanilla trades. The guys I talk to tell me that the OTC trading has essentially dried up in the equity derivatives markets. Some people are blaming the Volcker rule, other people are blaming market conditions. But if the banks cannot or will not commit capital, the liquidity in the hedging products evaporates, and this contributes to the VIX spikes. It may lift off episodically some of the SPX fall, but what you're going to see, the way the SPX fall is modeled, is really based on economic data. If you have that grind higher with the economic data, slowly improving, and the market sort of seems to follow, SPX vol can't really get crazy. VIX is a slightly different situation. Now, you can sort of see this and sort of mark to market some of what I said. If you look at some of the trading volumes, you see almost everything is occurring within short dated, within the first couple of months. Nobody's really going out too far beyond. Yes, are people doing it because their mandates require them to be hedged or to have other type of exposure like that? But essentially, you look at 1, 2, and 3 month expirations, and the bulk of the stuff is occurring in under 2. So if the banks don't commit capital, the specialist firms will have more control over the market. And when you have difficulties around the major events of the year, what we can think of as the known unknowns, I think you're going to see a degradation in market quality. You're going to start to see the quantitative dealers in the equity options market are going to widen out their spreads, and they're going to get nervous, and they're going to pull back. They won't commit as much liquidity. You'll have what you can think of as the cowboy dealers will widen their quotes, but they'll try to jump in to take advantage of the chaos. It's sort of the yin and yang of this market, and you're already seeing some of it, and I think it's going to be exacerbated going forward. Now, as an aside, what many people don't realize is that the dealers in the U.S. options markets, the specialists and the market makers, they each have sort of different responsibilities as to how often they trade, but in aggregate, they tend to be the largest customers of the stock exchanges. So what happens in the options market isn't so much, a volatility in a vacuum. It will bleed back and forth because these guys they have to buy and sell stocks to hedge their positions. Now, volatility, if you think about it, it exists mathematically, but if you look at it on a computer screen, you can click on it with a mouse. You can lift the curve up or down. And I think you're going to see a lot of whippiness around these sort of vol-NATOs in SPX sectors. You'll see that, and also in the single stock levels. Now, what we see, the volume is running, like I said, about 15 million contracts a day in the options market, which is fair to middle, and it's not super. On the big days, you'll see it at 20 or 22. But if you sort of drill down at a sector level, where you see the focus, and it's a lot like what happened last year and even the year before that, people are focused on the financial sector, they're focused on the retailers, which they think is the tell for the economy. They're focused on the restaurants because there's a theory going around that restaurant sales leads retail sales, and then naturally you're seeing a lot of stuff in the hot sectors like energy. The strategic trading that one would like to think exists, even amongst the real money, the slow money guys, isn't so much there anymore. You see people putting on big portfolio hedges very rarely. Instead, you see classic event-driven strategies around any number of events. And the big sort of trade, I call it, I'm going to date myself, but if you remember the Karate Kid, where there was like the wax on and the wax off. I own the stock. It's not going anywhere. I'll sell an upside call against it. It'll expire within 3 months or less. I'm 5 or 10% up, so I can take in the income. I want to buy something. there's so much fear of a decline, you usually find that the put vol is a little bit better on single and sector levels, and these are the things that are going on, and it happens day in and day out. Thus far, because of the big macro events, the volatility market's not as mind-numbingly boring as it was last year when it was a slow grind higher, but no one's going out there, on point, preparing for, a big vol at 60 like we saw during the crisis. So for now, and I don't expect this will change, the options market is going to speak to us in the shorter dated views. Portfolio hedging will not remain that popular, if for no other reason than anybody who hedged their portfolio in recent years lost money. So in closing, at various times, you can look at the options market to divine the future of the stocks. You do this by looking at trading patterns, expiration, and strike selections. But lately, one sees very little clarity in the options market, and this reinforces the view that 2015 is a year of volatile volatility, breaking up the monotony of an otherwise low vol year. Thank you.
Thank you, Steve. Great. Well, thanks for setting the table for me. That's a great backdrop to digress into bond land and a little bit of darkness for the room as you enjoy your dinner. I'll try not to be too dire, but effectively in bond land, we always want to regress a little bit in starting back to a global macro overview. And basically, yes, within the U.S., growth looks challenged, earnings look decent, the consumer looks okay. So why are bonds in the front end of the yield curve at 0% in cash, 50 basis points for the 2-year and 186 on the 10-year? Doesn't make a whole lot of sense to a lot of people. But we do think it makes an awful lot of sense if you step back and look at the global environment. And I think in bond land, more than in a lot of asset classes, there's an awful lot of international flows. And recently we've heard an awful lot about monetary policy. And I'll go there second. But first I want to talk a little bit about growth and how we see it. Secondly, what does monetary policy mean for the bond market and the global economy? And then third, a forecast. So maybe 2 minutes on each. On the growth outlook, it's interesting. If you look at the Boeing 777 when it was launched, massively popular plane, there was a little article that not many people noticed. The FAA was not going to let it fly overseas with only 2 engines. And Boeing was desperately afraid of their market being killed if that didn't get approved. Well, of course, the FAA isn't stupid. They approve it, and the Boeing 777 flies around the world. At that time, Airbus was running ads, safer with 4 engines. All right, so the global economy looks even worse than a Boeing 777 right now. Maybe it's got a great engine, but it's got 1 damn engine on it. And as bond investors, we wake up on that flight worrying about not can I get home or can I get to Iceland or Greenland with 1 engine, with 2 engines. We got 1. People want more certainty. Bond investors wake up facing an asymmetric world every day. You get your money back in a small coupon, or you get killed. And we think that kind of duality or that asymmetry in the world is what's helping to keep bond yields somewhat pinned lower. It's also helped by the complete lack of inflation in the world. U.S. inflation below 1%, 0.8% on a headline inflation number, and falling. That headline inflation number will continue to fall with oil prices pulling that down. But most people view that as transitory. But the world and central bankers, and I think the people in this room over the last 2 years have been trained to think about deflation being much worse than inflation. So in bond investors, we wake up hating the idea of inflation. As long-term savers, you hate that as well. And I think that paradigm has changed. There's statues of Paul Volcker that have to be built somewhere in every bond investor's offices because everyone wakes up knowing that it can be killed. If the Fed builds a zombie of inflation, we know that it can be killed. Just reincarnate Volcker if he's not alive at that point, which I think he still is. So we wake up now not fearing inflation, and everyone fears deflation. And why? Well, we're levered. That's why. The Western world and developed economies have taken on a lot of debt. And debt doesn't work very well when you deflate the nominal or the real growth in an economy. If you can create inflation and you have some debt, it can deflate away. So there's been a great party in the Western world. Western Europe is levered up. U.S. is levered up. It's unlevered a decent amount recently. But it's that fear of the downside. The fear of the deflation is extremely prevalent, and we think that's why central banks are where they are and why the yield curve is where it is, that people fear deflation a lot more than inflation, and that's why you've seen negative yields in Germany recently and very low yields in the U.S. So you got 1 engine of global growth. That doesn't make people feel very, very confident. You've got Europe with an identity crisis, trying to find out if it's going to act as 16 or act as 1. We think the ECB's announcement tomorrow is critical, not to move borrowing rates for the German government from 4 basis points for 5-year bunds. Woo, let's move them to flat. We're going to have a party. The world's going to grow like crazy. That's not the point for us. It will help incrementally, but we think there's a side benefit. The ECB is pulling together Europe. It's almost creating a conversation that starts tomorrow about if we start buying each other's bonds and one of us defaults, what happens? And that starts to limp down a path of a fiscal conversation. Am I going to cover your debts if you go to the table or not? I don't know. Maybe you shouldn't bet on roulette. Go play craps, better odds. So suddenly this fiscal conversation starts, and our belief is that if it starts, it's unlikely to stop. And if it starts, that decreases the odds of the Eurozone splintering or having an existential debate like it did during the Greece crisis. So that's about as positive as a fixed income guy can get, is that Europe, who knows what it is? It's incredibly uncertain, but they might just muddle around long enough to make themselves kind of sticky and systemic together, and that's good news. And that's one small outlook for growth that's a positive that we see that we think the markets might be underestimating. But one other reason that the outlook for growth and fear of deflation is high is the emerging markets. The emerging market growth, generally, there's been good surprises, Paul, as you mentioned, in India. But by and large, people wake up wondering how much China is slowing. Again, it's that fear of the downside. No one's imagining when will China hit 10% again. And it's that downside bias as far as growth and that reliance on one engine, while strong. That engine, if it quits, the U.S. economy quits, just kind of step back for a second and think about the next job report coming out at a 0 or a negative in the U.S. How would you feel in your portfolio? You would step back and you say, well, I can't go to bonds. They're already near 0. Equities are at a 16 to 18 P, depending on which forecast you're looking at. And growth is rolling over. I don't have a single engine. It's a matter of where I land in the ocean. And central banks perhaps are going to throw a bunch of life rafts to me, but what does it matter now? Rates are already 0. So I think the world is desperately close to a scare. If U.S. growth falters, this gets very dark very quickly. Now, we don't think it's going to falter, but the point is to take equity valuations higher, to have the Fed actually hiking interest rates. We think you need another engine. And that other engine is likely to be Europe, in our opinion. That other engine may prove to be a more resilient China than a lot of people think. That engine might be Brazil and the rest of the emerging world actually re-engaging in growth policies after actually kind of having a nice party on the back of QE where a lot of easy money flowed their way. So that's our backdrop for growth, which may be a little dark, but actually I think is tinged with some positivity in there. As far as monetary policy, one of the things that we'd mentioned, obviously big ECB announcement tomorrow, we do think there's been an over-reliance on monetary policy. There's meant to be multiple levers and determine if the market should go up or down. And it's felt an awful lot over the last 3 years like bad news was good news. And we think we're near the end of this cycle. So when a bad number comes out, give me more morphine, Fed. I don't care if growth is good or bad, just shower me with free money and the world will go up. We think those days are over as you approach that 0 bound at interest rates. How much lower can you go? So that game is ending. So in our worldview, you need a handoff. You need a handoff to real growth. And we think you're seeing that in the US. And if you couple that with any foreign growth, this thing can take off. And then I could almost become as bullish on equities as Jonathan, maybe not quite that bullish though. So we think monetary policy needs to be relied upon less. The ECB will take the reins from the Fed a bit. We'll see that tomorrow. We do think it'll happen, €1 trillion. And that's good news in the near term, but we're looking for real signs of growth underneath that. So as far as a forecast and an outlook, we're at 50 basis points on the 2-year Treasury today. A great way to look silly is to forecast the yen or the 10-year Treasury. Not many people would have guessed 186 as we sit here today. I will give the uncommittal low 2s, maybe mid 2s. Some of the team may be already throwing stuff at me that's too high. But the point is that it's predicated not just on U.S. factors. And I would urge you to think about that the price of the U.S. 10-year Treasury is a global commodity, priced just like oil, priced just like copper. It's not just a U.S. commodity. And we believe that U.S. credit is priced the same way, and we think that equities are priced the same way. So we think you need to have a global view. So that 186 likely moves up into the low twos. The curve, 2s10s yield curve, we're at a 135 right now in that spread. We flattened from nearly 300, so the curve is flattened an awful lot. So that 186 doesn't make sense to a lot of people when they say the Fed's about to hike. Why would I lock up money for 10 years at 186? And I just want to walk through a couple stats and what the bond market is implicitly forecasting there. So a popular question you can ask some friends at a cocktail party is, when's the last time you could get 5+% on a cash rate in your bank account? And people will think long and hard about that. And investors will too. They'll say, oh, geez, was that back in the inflationary 70s, 80s? When was that? 2000. Well, it was 2007. You can get 5.25. We had times last year where you couldn't get that in high yield corporate bonds, right? So yes, it's official. Yields are low. Yields are more deflated than, what is it, Jay? New England Patriot footballs, I think that's right. So sorry, I shared that one. But they haven't always been this low, and they won't always be this low. But look, for some context, Fed funds rate in 1980 was 20%, right? So that was at the end of the Fed hiking cycle. The next cycle, in '84, they ended at 12%. That's a lot lower than the 1980 cycle. In 1990s, they ended at 10%. In 2000, they ended at 6%. You see a pattern here? Each Fed hike cycle, 20, 12, 10, 6. The last cycle in '07, we know all ended at that same 5.25. And now we're at 0. And the parlor game is, okay, how high does the Fed go and what is the bond market saying? Well, a key piece of information is that in those last 3 cycles, 1990, 2000, and 2007, when they finished, that 2s10s yield curve was inverted every time. No one likes to forecast a recession. No one likes to forecast a fall in the equity markets. And no one likes to sit here and forecast an inverted yield curve. But guess what we've seen the last 3 times? And guess what the bond market's telling you we're going to see again is an inverted yield curve. So I would like to propose that you could think about the 10-year Treasury as a prediction not of necessarily the forward rate of 10 years of cash, but not a bad predictor of where the market thinks the Fed may get to. They might not get to 2%. So the Fed's forecast is for a neutral rate of, say, 4%. The bond market's saying, yeah, sure, take half of that and you're about right. Maybe you get to 2. And we think that's right. We think they can get to about 2. If the world re-engages in growth, yes, then we're in inning 6 of a 10-year, first 4 years we're deleveraging. Maybe you're in year 6 of a 10-year plus rally. That's the good news, but you need the world to re-engage, not just the U.S. Within high yield bonds, within that forecast, if the yield curve is going to flatten around a 2% level, that'll surprise a lot of people. If the world's growing, it will push money into equities, which will provide superior returns than bonds, which will likely have a mid-single-digit return. High yield is at a 6% yield currently, 6.30. Doesn't look that bad. That's a 500 spread. If you were to just not know anything about markets, come to the earth and land and ask someone what a high-yield bond is, they'd say, yeah, it's something that generally yields about 350 to 700 basis points more than a U.S. Treasury. That's what it generally is in. Well, it's at 515 right now. Oh, 350 to 700, that's a fair bet. Earnings are good. Defaults are low. I'll take that. What about investment-grade corporate bonds? 90% of the time, they're between 100 to 200 basis points over Treasuries. They're 136 today. Yeah. Don't love it. Don't hate it. Sounds about right for a mid-cycle. So the spreads look about right. They're forecasting moderate growth. The yield curve looks about right. It just looks weird to everyone who doesn't approach the world in that weird asymmetry that bond guys do. So with that, I'll stop and hand it back over to Paul.
Thanks, Matt, and thanks to Jonathan and Steve. So we've got about 25 minutes for questions. I certainly have a few for our panelists, but I hope there are plenty in the audience. If you stump us, there's a prize. But why don't we open it up to the audience? There are microphones in various places. I don't know if we're going to have folks running around with them or if you just step up and ask your question at the mic.
Ross Capron, Morgan Stanley. I got a observation and 2 questions, one specifically for Jonathan. Jonathan, I've followed your work for a number of years through the firms, respected a lot. The first question is it more difficult to be a bearish sell-side equity strategist than it is a bullish strategist? And the second question, directed to all of you guys, is what worries top your mind and what signposts specifically do you look at for each of those worries?
And just to, thank you for the questions. When you mean, is it more difficult, is there political pressure from the firm, or is
Exactly.
it? Okay. So maybe, Jonathan, you want to take that one? Maybe you don't talk about it in your current firm, but maybe you talk about it in the firms you worked at in the past.
I'm going to talk about a hypothetical.
A hypothetical firm.
Yeah, you know, first of all, the answer is yes. I mean, the answer is it is more difficult. I think that if you are bearish and right, I think that you're fine, but you have to always be right. So I think it becomes a little bit more challenging. And so I just like an analyst who we know that Wall Street analysts have a bias towards being more optimistic than over time. So what I think investors tend to do is if an analyst is saying a company is going to grow 15%, investors often say, well, okay, well, if we haircut that by a little, is that a better estimate? Perhaps there are people who, look at things, in that kind of a light. But I think, listen, I got to work every day saying I want to get this right. I want to help my clients, and if I take the heat for it, I take the heat for it. But there's no question it's more pleasant to be when you're bullish than when you're bearish. But if I think the world is falling apart, I'll say it, and if I take my lumps, I take my lumps. But yeah, there's no question. As far as what keeps me up at night, I think that, Matt, I think that you really kind of hit it on the inversion of the yield curve, and I think it's really two things, and they're all really bond-related or recession-related. First of all, we are in uncharted territory. We have no idea whatsoever what this thing is going, how it's going to play out. We've never seen any country go into QE and successfully leave QE. The Fed doesn't know the way the market's going to respond. So we've never dealt with the zero bound before. So if the Fed takes this very slow and in baby steps and lets the market absorb their rate hikes, then I think that they'll get a lot of feedback from the market and from the economy and tell the Fed whether it's okay for them to take the next baby step. And the Fed, I'd be shocked if they're going to do anything other than that. If there was a single indicator that I would look for, historically, the Fed surprises to the hawkish side when inflation accelerates more than expected. Now, we know that, you guys were talking before, we know that inflation is going to be really low because of oil. But if wage inflation were to start picking up more than expected, you could have a 0 CPI, and if you had a 2.5 print on wage inflation, the Fed is going to really be in a very uncomfortable position and may become more hawkish in their policy. And if that were the case, then you could start to see the yield curve invert more quickly, and it could create problems. We could talk about the other thing, which is a little bit different, and we didn't talk about it yet, is the most important commodity in the world has fallen 60%. The dollar has moved in an aggressive enough way that it's helped contribute to things like the Swiss peg breaking and all kinds of other things. If you look at the VIX, where it averaged last year, and I don't know where it's averaged, 13-ish last year or something, up around 20, the market is telling you that there is a lot of strain right now. That strain does not say the likelihood of recession is higher, and therefore I think that the market is probably fine, but the size of the tail risk appears to be larger, which is why people are trying to address that. And I think it's all about the dollar, central bank policy, oil, and I don't even know how to handicap some of this. So I don't know if you guys have thoughts on that one as well.
I mean, I tend to think that America is sort of the best house on a bad block, and a lot of money is going to come here because it has to find someplace. And because of that very simple reason, I'm largely constructive on stocks. What keeps me awake is this sort of nagging feeling that these giant tectonic plates are moving around. And sometimes I'm worried that I'm focusing too narrowly on something and perhaps missing something else. So you take like the Cuban embargo, for example, and whatever the president has said, what the president has said, but the truth of the matter is Cuba is the second largest economy in the Caribbean basin. China's down there, making massive natural resources investments. And I sort of feel like all these things are being stitched together. They're being stitched together someplace that is outside the realm of the markets, and that we sort of pick up some of the scent, we pick up some of the action, but I don't know that we have the full picture. And that's sort of a little bit different than like the unknown, that we've got some sort of hedge fund blows up or something else within our data sets, arises. And I try to do a bunch of research, like what happens at the turn of centuries, is a regime change, and what happens, and there's just not really good, I haven't found any great clarity on it. And that's the kind of stuff that really bothers me on a daily basis. We all talk to who we talk to, and we read what we read, but I fundamentally just look at, a big bank of screens, and I've got all sorts of things on there, from each sectors and volatility and things that tell me that I believe are tells, and certain people at certain junctures on the street that have pretty good insight. And those are the things I watch. And like sort of the unofficial thing is, if there's a big move, I call it like my, like the voice indicator. There are certain guys I'll call up, and if their voice is very panicked, then I'm like, then you know that it's going to be really bad. But thus far, I haven't seen anybody sort of have this really strained voice. Everyone's been pretty ice cold about it. Now you have the ECB, and I think that'll be, obviously that's the big tell. And even though they're expected to move forward, there are some expectations amongst the guys that I talked to and some of my colleagues talked to who were never mentioned in print, but who are very influential on the street. And they say if the U.S. market goes up, we're going to short it with almost everything we have, because they think that the sort of negativity will reassert itself. So as these sort of tectonic plates move about, everybody's watching it, but it's really outside of the discipline. And that's what haunts me at night.
Yeah, kind of similarly, it's for us, I'd lead with the unintended consequences of QE. We don't know how this ends. If you kind of view it as a patient on oxygen, can they get off of oxygen? Or use a different analogy of, perhaps the U.S. economy is strong enough that steroid regimen allowed us to grow more muscle and come back into the game. But what if the Japanese economy is, in that analogy, if we're 35 years old, the Japanese economy is 98 years old? Give them all the steroids you want, not running a marathon. And there's a concern there that it's going to act differently in different economies, and there's now a broad adoption of it. And so the Eurozone, all right, maybe it can run a 10K. We're, probably not a marathon, but we'll give it a chance to run. But we don't know. We don't know how this plays out. So we're now in the realm of unintended consequences, and one that we've thought a lot about was not how far would oil fall, but how far overvalued was oil, and did easy money help that? So how many people in the room and their financial advisors and big firms were saying, well, geez, I can't possibly buy bonds, fixed income. Commodities sound like a good bet if inflation is going up. So big asset allocation trade, how high was oil to start? How overvalued was it when you had a massive supply glut and it was all hidden by easy money? No one was talking about that 3 months ago when oil has already been well into its decline. That's probably a factor, and I don't think many people saw it. It's those kind of unintended outcomes of QE that we don't understand yet. That's what we fear most. And lastly, in that vein would be if QE is a volatility suppressant. I haven't met many people who would disagree with that statement. What is the removal of QE? Probably, it'd be logical to say it's a volatility accelerant. And if that's true, and we have financial markets that are less liquid than they've ever been, and larger than they've ever been, then that volatility is going to be hard to consume. That keeps us up.
To pick up on the volatility point, I'm just starting to hear people postulate that the QE doesn't ever really end, and that rates perhaps might not rise in the third quarter, and that the things happening overseas kind of checkmate the Fed. The people that are telling me this again are these would be our, some of our best situated sources, but you hear it at different houses and you hear it at different funds, and after a while, these guys tend to be right most of the time. It gives you something to think about.
We have another question?
Two quick questions, please. One, what's missing in this recovery is the normal multiplier effect of the velocity of money. Would you comment on that, number one? And number two, it looks like at least ex-US we're engaged in competitive devaluations. Would you comment on that?
Who wants to take the velocity question?
Pass to you guys.
Well, I'll take a first short stab at it. I think that the Fed did a brilliant job of putting a floor into the market when the financial crisis was in the post-Lehman period. I think it is really hard to know whether or not the QE had any impact, since then, and I think it'll be very, very difficult to measure because, yes, the velocity of money, did collapse. And if you talk about modeling vol, to me, and we model vol as well, it does not look like free money changed that equation. And if you model where interest rates are, which I do as well, it tells me that the reason that interest rates are low is because they're really low in Europe, and there's a swap out between German paper and U.S. paper. And so I'm not sure that the central banks have had nearly as much of an impact as we all want to give them credit for. And I think that the underlying drivers are perhaps bigger than central banks are.
Yeah, and the only thing that I'd add is that ultimately you can change the price of money, but you can't easily change a desire to save from a desire to overconsume. And I think in a lot of the Western worlds, in Europe, it's taken the form of austerity talks. In the U.S., in general, some of it's demographic. The desire to leverage and to spend is not there. There's a desire to save. When you take out a loan, you're committing to an income stream. When you buy an investment, you're hoping for an income stream. There's a lot more people that want to invest in their future and not consume for today. So the velocity of money is about the willingness of the banking system to lend and the desire for people to take up those loans. And I don't care how much water you put in front of this horse, a lot of the U.S. consumer base does not want to relever right now.
I think the credit crisis actually had a profound impact on John and Jane Investor. And I have friends we have friends in Germany, and if you know about German investors, they tend to be very conservative. What do they own? They own real estate. They don't really have a lot of debt. Equity's not that big of a thing for them. Maybe they have some fixed income. And just sort of being out on Main Street and talking to people, I see the same thing. And despite the consternation or anxiety many of us might feel who are involved in this industry, you go out and you talk to people who actually have non-financial jobs, and I just don't see them as panicked as one would expect. They just sort of seem to be thinking about retirement. How can I generate a reliable income? And that's about that.
Just to one last thing on the velocity of money from a more technical perspective, a shadow banking system artificially increases the velocity of money because if you think about the identity, you see the PQ side goes up, the M side is constant, so to solve the equation, V has to go up. So we had a tremendously large shadow banking system going into the 2008 crisis. It collapsed post-2008. The way that would show up is a drop in velocity relative to pre-crisis. So it could also be an artifact of the shadow banking system collapsing as well. But second question was competitive devaluation. Are we seeing it?
On what valuation?
I believe the gentleman's second question, are we in a round of competitive devaluation? Is that correct? Was that your second question?
Clearly, yes.
Yeah.
I mean, it's clear. I mean, yeah. So the Swiss National Bank just last week basically said, I'm trying to keep my currency down and I give up because ECB, your cannon's 20 times larger than mine. I'm done. Right, so I think it's clear that the answer is yes. The point is, once everyone does it, then it doesn't matter nearly as much. So one of the ways to turn back on the other engines of this jet is to make the U.S. less competitive. And sorry, the rest of the world fully participated in our financial crisis. Thanks for buying those dodgy mortgages. We didn't buy Greek debt. Of course we're in better shape. They took a big hit. Generally, the U.S. did not participate in the current malaise in Japan or the current issues in Europe. And much more aggressive in monetary policy and much more aggressive as far as growth policies, even though they're subdued in many investors' mindsets. So the U.S. currency is going to get strong enough until it lights another engine of growth. Ultimately, it's bearing the weight of that. And as it strengthens, maybe Europe fires up that engine or EM fires it up. And we might feel comfortable with those four engines of more spread growth than just the U.S. That'd be our view.
Next question.
If the European Central Bank decides to buy bonds tomorrow, what will be the effect on the U.S. stock market? And whatever answer you give, what are the reasons that you come to that answer? Thank you.
can I just make one quick comment and then we'll throw it to you guys? Everything I think is relative to expectations. So the expectations are they're going to do $500 billion in a year or something like that, and then kind of see where they are. So it's kind of expected that they're literally just hitting the bid. If they really wanted to move the needle, they would do shock and awe. They announced $1 trillion in a year or open-ended at that rate. Then I think you get the dollar strengthens and the euro falls apart. The same way that the Fed dots are telling you that you have 3.5 Fed funds or something like that at mid to late 17, and the futures market in the U.S. tells you you're between 2 and 2.5. And so the baseline is probably more important, as important as the action. So with I don't know what you guys have thoughts on that, but
I mean, I'm going to frankly dodge the question. I don't think it pays to be a hero here, and I want to wait and see what happens, and then I think we'll have a better sense of things. But the expectation stuff is key. If the expectations aren't met, we'll probably go to hell in a handbasket.
Yeah, and I'd say that our take is that ultimately it's a willingness to do something that's worked somewhere else. It shows a proactivity and a desire to keep it together, to extend the experiment. So the lack of aggression, the lack of any other entity within Europe to be aggressive, given austerity bounds and structural inefficiencies, those things change very slowly. The ECB can be aggressive. So it shows a willingness to try to hold this together. And if that willingness were to fall apart, then I think an awful lot of people here would turn dark pretty quickly, because you'd start to worry about the European banking system. You'd worry about Deutsche Bank, and then you'd worry about how many lines do they have to B of A, and it would all start again. So we think that A, it shows a willingness to hold it together. B, a lot of that money will be exported. You can buy a German Bund or you can buy a U.S. Treasury and pick up over 100 basis points, and the currency is likely to help you over time. So we think it increases global valuations, not just European, and that's why equities expect to perform well into anything on the order of €1 trillion.
It seems to me that last year before that, there was such overwhelming concern about the deficit, getting our spending under control, that there was the Armageddon of fast money, and yet I really haven't heard that this evening, and yet I do hear it from our political class. And I was wondering if maybe the press is suppressing some of the recovery because they are still looking backwards instead of looking forward, or if politicians are still looking backwards instead of looking forward. I mean, if we had a change in tone, you all are saying, hey, we're the engine, we're growing, that maybe that would contribute to maybe more optimism and more recovery even globally.
I saw today that consumer sentiment was at the highest it's been in 5 years. I think around having spent some time earlier in my career in Washington, I think that fear is a pretty good commodity around elections. I am a member of the press, but I'm only here to talk about my 2015 volatility forecast.
So, but I think there's, Kathy, I think there's a couple of things about the deficit issue. The truth is, in the short run, things have gotten substantially better, or I don't say substantially, it's probably an overstatement. In the short-term view, two things. Interest rates being low make it a lot easier for the government to finance their debt, and that takes some pressure off. And deficits have also come in lower for a variety of reasons, including the fact that we've also cut our expectations for defense budgets and sequestration. Long-term, we have a massive problem, and if you looked at this as a chart, you have this dip before it explodes, and this thing is going to come back, and I don't know whether it's in the 16, 17, or 18 year that this becomes an issue. And yes, the people in Washington have chosen to not make this a near-term fighting point, so it's gone out of the press, but we have a major problem with funding our deficits, and demographics make this thing worse. If there's good news is it's a lot better in the U.S. than it is in much of the developed world. The bad news is that everybody has a leak in their boat. The question is how big the leak in their boat. So I think it's gone away temporarily, but I think that's all it is.
I think it'll reassert itself. If you look at the demographics today and the aging of America, we have roughly say 2.5 people working, 3.1 people working for every retiree, depending on which forecast you want to look at. Is it the Congressional Budget Office? Is it Brookings or somebody like that? They say in 14 to 16 years it becomes 1.1 to 1. And so you have these sort of massive stresses because if the average IRA or 401k balance is $43,000, everyone thinks they're going to eat lobster when they retire. And so I think you're going to have that with the deficit's going to sort of coalesce. But my sort of simple way of thinking about what the Fed did and the deficit, it was like making a massive, it's like a massive bed or putting the paddles on the patient to shock it back to life. And if things shock back to life and the economy starts to grow at a little faster clip, maybe these big issues that are massive overhangs actually fix themselves. But I suspect that if they don't, the politicians will have some policy measures that will try to fix them or at least push them farther out.
Yeah, and I completely agree. The only thing I'd add quickly would be that there are different forms of government spending and deficits, in that entitlement spending is the third rail. Ultimately, that's proven part of the unwind of the Japanese fiscal situation is just promising for a drip feed of a lifestyle for retirees. And that's probably the biggest deal to attack within the U.S., and I agree with the question. It will come back. On the flip side of that, if the world's willing to lend you money at 1.75% for 10 years or 2.5% for 30 years as the U.S. government, any project that you can actually build that has an IRR greater than that has a social benefit beyond that, becomes an asset. So not all government debt is not unchecked by an asset. So you can't make a strong fiscal investment argument or a partnership with business investment argument that at low yields, if the world's going to suppress your interest rates, borrow. Don't borrow to guarantee a lobster tomorrow. Borrow to make some airports that look better than those in third world countries. Borrow to make transport. Borrow to make ports. Borrow to champion different businesses and spur investment. I think there are some forms of deficits that are not bad, and there's some that are.
I'm curious to know, as the demographics change and the baby boomers retire, I believe they began this past year, thoughts on what allows us to grow longer term. Is it productivity and immigration? And then as much from a corporation's perspective, do you envision organizations changing their capital structure to appease and pacify their investor base? Thanks.
I think it's clear that we have a mountain to climb. And I think that the demographic headwinds create an awful lot of people that want to buy bonds at yields higher than this, and that's why bonds are going to have a hard time getting to yields higher than this. I think there's a lot of people in this room that would love bond yields to go up, and that's probably why they won't. I think you will see an extension. I think you see an awful lot of people that won't be able to retire with their 401k at $43,000. I think that keeps the price for an awful lot of things lower in our consumer fed and in our service economy. You don't need to be 28 years old to be the starter at the local golf club. That's okay. You can be 70. That's good. So I think that people will extend, and they won't retire nearly as soon. And then ultimately, I think immigration, this is a political statement, but I think immigration policy in this country has to be severe, really, really looked at hard. It's hard in different states. It's hard in different cities. But ultimately, this is a country that attracts immigrants. It attracts an awful lot of high-paid jobs, and that leads to growth. And I think that an intelligent immigration policy to grow the population should continue to keep U.S. Productivity levels higher than the world. So maybe that's a little bit of a hope more than anything, but this has proven to be better than most as far as surprising the upside. I think the immigration argument is one that has to be had in Washington.
By way of a point of trivia, the number of millennials surpassed the number of baby boomers last year, primarily because of immigration.
Do any of them work yet?
I mean, if you,
No, it's different. That's a
Paul, but
different
if
story.
you look at the census data, and I know only nerds like you and I go and go through and read this stuff, but
Got some
I release myself. But I think that this belief that you have this group of people and all of America is going to retire. I mean, yes, you had this wave of births after World War II, but since then, a lot of that, the hole afterwards got filled in by immigration, and I think that this is a slow process. We're the only country, we're the only major developed economy that has a full replacement on our fertility rate at a little over 2 children per couple.
It's
France,
dipped a
okay,
bit, but
France,
yeah.
France is the same, but they're France, and the UK is one. Apologies for anybody's French. UK,
No, we've been very
you-
lucky with immigration and population. Population growth is a wonderful thing. We have it.
We
We're
have
one
it
of the
now.
few developed countries that have it.
Right. Now, the thing is what we have is really, we have the debate on immigration policy is so obsessed with border security as opposed to bringing in the right kind of immigrants and driving growth that I think that I'm not particularly optimistic that the policy won't be about border security and a path to citizenship as opposed to how do we grow our pie so that we have I mean, listen, the best way to deal with these retirement, Social Security issues is to grow the population base, let people come in here because we're a vibrant economy, and grow the pie. But I don't hear that as part of the immigration debate today. But I don't see why it couldn't be a positive debate.
It's not being, you don't hear it, but it's happening, right? Because you see the labor, at least immigration is causing the labor force to grow. So, when we think about GDP growth, we study it quite a bit. We don't see anything broken from the tautology that GDP growth equals productivity plus population growth, right? So that hasn't broken. It's just the question is, what will productivity be and what will population growth be? At least population growth in the U.S. is positive, whereas in many other countries, it's negative and in very bad shape.
And one more point to that is a very popular debate is that intergenerational wealth transfer. So there's effectively a tax on it's something we talk an awful lot about on the team. There's a tax on the young to pay for the old right now, and it's hey, enjoy your retirement. But the young are eventually going to outvote the old. Right, and so this balance.
They're going to start paying attention at some point.
Right, at some point they better, motor voter maybe didn't get them there. At some point they have to realize that maybe Grandpa's retirement shouldn't be quite as lavish because it's on their back. When those voting dynamics change, you could see simple caps or better means testing. There's lots of things that can slow that very dramatic ramp at the end of this annuity stream. And ultimately, I think that dialogue is happening in think tanks. Our government tends not to want to act too quickly on these. You need a crisis before anyone's courageous. But there are things that I think can be done. And as the voter base changes, I think you'll see a change in that dynamic as well. I also think, not to digress too much, but I also think the retirees don't want to live a guilted retirement to only watch the economy in plunder. Right? So there are feedback loops ultimately as well.
Okay, well, thank you, gentlemen. This was a great panel. Thank you, audience, for your questions. Some of us will be around after dinner. You can please come up to us if you have any additional questions. But also, thank you for giving me the opportunity to pinch hit. It's been a great experience.
Yeah. Thank you.
Please
Thanks, Paul.
Join me in thanking Matt, Stephen, Jonathan, and Paul for providing their insights this evening.